Okay, good morning, everybody, and welcome to the Daily Energy Markets Forum webinar, where we take a time out to review the market open in Asia and the outlook for the day ahead across the world. I suppose if there's ever a day to start in America, today is the day with my new favorite person, Amanda Gorman. I think everybody in the world's falling in love with Amanda Gorman this morning. The poet laureate who read yesterday at the inauguration of Joe Biden. And with a name like Gorman, us Irish will have to claim her as well, even with everything else. But Mike McGlone, welcome back to the table. Thank you so much for joining us this morning, or this evening, I suppose, given it is late in New York, in Connecticut. Mike, what's your outlook for the markets at the moment? I welcome your views at the start of the year, although we're 3 weeks into it. Prices sort of hovering at 55.
Yeah, well, I think you echoed the sentiment well. The key thing globally, I think, is relief from a political standpoint. And that's one thing I think our former leader did not understand when he was doing debates, is how much pain people were in. He needed to be more kind, and he wasn't. So I view the crude oil market as getting boring, stuck in a range, 60-40. And I hate to say that as a commodity strategist, but I don't see Brent sustaining much above 60. I see it at high risk of heading more towards 40. And the key thing is it's very near, I believe, near the upper end of the range. And there's a few key things. It needs fuel to stay higher. It needs continued cuts from I would say, agreements of cuts from OPEC, which we all know is not going to last very long. Shale's coming back on. I talked to a producer last week. He says his break even's 45. So break even's around 50. Now that's WTI. It definitely needs a continued rise in the stock market, most notably US, because the correlations are very high. So I view the whole commodity sector is a little bit expensive here. Copper at 800 is, yeah, I'm bullish, but not at these levels. It's just, I'm bullish copper, but not at these levels. So I'm very skeptical of these levels, and I think like the latest data we've seen in demand is basically that was the trend before COVID. It was these downward estimates in demand, and now we're getting them again. Just way too much optimism for a recovery in what was a bear market before in crude oil. So I hate to go that way, but when I am a commodity strategist on a broad view, there's one sector I cannot expect higher prices to sustain without something unexpected. It's fossil fuels, most notably crude oil. With that, I pass it back to you.
On the sort of drivers, Mike, you mentioned OPEC, but in the US, there is obviously shale possible comeback. There's also the stimulus. What's your outlook for this $1.9 trillion stimulus and this sort of bipartisan solidarity in the Congress?
Well, I love the first narrative when the stock market initially went down. It's darn, we're hoping for 3 trillion rather than 2 trillion. It's 1.9 trillion. And that's why I cannot be anything but bullish gold and precious metals, because that's a trend that's not going away. It's accelerating. More debt to GDP, more QE, more MMT. And that's obviously good for gold. But in the US and a lot of the world, now we're becoming so dependent on this type of stimulus. Yes, I think that's good for infrastructure spending, which is really not part of this package, and things like copper. But crude oil, Biden's going to reduce that drill at will mantra of the Trump administration, but it's going to switch more to clean energy, which means reduced demand. And that was the problem before. Incremental liquid fuel demand in this country is the same as it was 15 years ago, despite the economy taking off. Or at least GDP increasing. This has never happened in history. That's part of the paradigm shift I see in energy. That's why I think we're stuck in a range. Last year was a pretty good low. 70 last year was a pretty good high in Brent, and I just don't see much getting outside of that range and just narrowing in. This concept of a full recovery anytime soon, and demand with U.S. unemployment running 7% versus last year's 3%. I think it's way too much optimism, and we need more of this stimulus, which is becoming we're addicted to it now.
We're all addicted to stimulus, except for James McCallum, the executive chairman of Xergy and a professor of energy at Strathclyde University. He has his own stimulus bucket that he has. James, welcome back to the table. The 21st of January, new president. Oil markets looking relatively robust. Even Halliburton yesterday came out with their results with a big smile on their face. What's your outlook for industry recovery?
Yeah, great. I'll come to that in a second, Sean. Although, but before I do that, I would just like to correct a couple of cultural anomaly references, which you've been guilty of, and indeed yesterday Biden was guilty of. I suspect that claiming Amanda Gorman is Irish is a cultural flaw there. That's the first one, and secondly, Biden claiming Irish poets as the greatest in the world this close to Burns Day really comes into a bit of question for me. So a couple of cultural references there.
He deserves. You have to tweet to him and remind him.
Yeah,
he's sure to have Scottish blood as well. One can't imagine he's a pure paddy.
Yeah, well, we're reeling a bit from presidents that claim Scottish blood. We'll be glad to see.
Yeah, we like the last one you sent us.
Yeah. So where am I on the year? Look, I think the Halliburton accounts are very relevant when you're taking a look at the sector from a service sector standpoint. I mean, I'm always going to draw attention to the OSX Philadelphia Oil Services Index, which currently is up 100% on well, more than 100%. It's doubled where more than doubled where it was a year ago. But to reflect on that, it's around about 50. It was at 200 at its peak, and I think Halliburton's results reflect something very similar in that regard. At best, they were flat, and they certainly were flat internationally. They saw a 0.4% revenue growth internationally over the year. So nothing happening internationally. Quite a lot of free cash flow in the business, but that came from improvements in business efficiency, cutting infrastructure costs, cutting personnel costs. I think the thing that quietly went unnoticed in the Halliburton results was that most of their growth story in North America came from completion and production operations. And that is very critical to something I've been pointing out for some time, which is that the activity which is driving the Baker Hughes rig count index up to around about 400 rigs. Again, worth commenting, down from peaks of around 1,600. That is coming in activity where production is being brought back on stream from wells which were already drilled, but not necessarily produced. So quick production being brought online. I do agree with the comment just made that we are into a new range for oil prices, which is probably in the 40 to 60 range, and we need to live with that. But the bit that I'm really excited about, Sean, is with a new president in the White House, where his policies are undoubtedly going to be a great deal more considered in their nature coming out, whether you agree with them or not. We have clearly entered a 4-year cycle where policy is going to be driven by global agenda rather than Texas agenda. And I think that's a great thing for the planet. I also think it is a great thing for the industry because we have firmly now entered the era of the low-cost producer where it's all going to be around business efficiency, low lifting costs per barrel or barrel equivalent if you're a gas producer, and I guess you're rubbing your hands together at the moment if you're a gas producer as the world moves increasingly towards a hydrogen agenda. And it's all going to be about digital transformation. And not surprisingly, I'm really excited about that.
Thank you. Andy Laven, good morning, Chief Operating Officer at Sahara Energy Resources. Andy, welcome back to the table. We were sort of seeing at the beginning of this short year so far, 3 weeks, that oil was soared above Brent, above 57, and it was only a matter of days or hours that 60 would be conquered, and we have dropped back from that since. What's your own read on that, and where do you think the momentum would be to get us back towards 60?
So I think I would say that the market is exceptionally complicated. Okay, so as Omar has been pointing out, the oil market is very financially driven. So it's driven by emotion and people want it to get better. Okay, so there is a momentum to take it back up. But I think what we're going to see in 2021 is the market is going to be constrained by demand. Demand is the key issue here. Supply is not a problem. If we wanted to go up another 10% in the next 6 months, it could be done. The problem is nobody wants it. So demand is going to be the real key. But demand also comes back to people. So you're going to have these tensions all the way through the year where people want to see stimulus. People want to see it positively. People want to see it going back up. So there will be a drift, I believe, in the market moving back up towards 60, but there's going to be a cap on how far that will come up towards the 60 that is basically being constrained by demand. So you'll see a drifting upwards, and then if there's news on poor demand or flights being cut, it'll get a kick back down, it'll go back down again. So I see it actually drifting up rather than drifting down, unless there is a big change in the supply side. So if OPEC started overproducing, clearly the markets are going to crater. But that's something which is within OPEC's capability to not do. So my view is it will be fairly, I wouldn't say bullish. I think it's going to drift upwards slowly over time through this year.
Mike, I'm just reading a comment by Mike Muller in Singapore. I wanted to throw at you. With spot Brent at 57, a 40 to 60 outlook is bearish. Are the first two panelists, i.e. Mike and James, calling the top of the market? So I'll throw that at you from the chat room.
I will not mince words. I'm bearish crude oil. That's it. Crude oil was in a bear market before COVID. I think we're near the upper end of the range. I think we're near the upper end of the range in copper, in U.S. bond yields. And all the market needs is one little spike or spark, and it can easily drop 20%. It's going to be much harder to rally 10%. So the next $10 in crude oil, I think, is down. It needs some more fuel that's unlikely to continue this slow rally. So don't want to mince words. Bearish crude oil, been bearish crude oil for years. And I look at it from a macro standpoint. Anytime you get a chance, I look at it, you're supposed to be selling rallies in crude oil and buying dips in gold. And that was the mantra well before COVID. I don't see why that should change now, except one thing is we probably put an all-time low in crude oil, minus 40. WTI is pretty damn low, but we're just going back to where we were before. And we think things are changing. Just what James said, kind of excited about what's happening. This clean energy revolution is accelerating. This decarbonization trend is accelerating. Just can't be bullish that primary fossil fuel commodity in that environment. And I like to always bring it back to one key thing. James mentioned gas. U.S. natural gas to me has been one of the keyest, best indicators of deflationary trends for 10 years. And that is one thing I find unique is where I'm sitting in Connecticut, it's pretty darn cold, but in the whole country, everybody's switched to natural gas for demand, for electricity, from heating, yet supply is still overwhelming because of one key reason, technology. And that's one thing that humans always have missed in history is how technology just massively produces supply. And in this case, it's a paradigm shift in energy. It's also reducing incremental demand. I mean, every new vehicle in China, all these people riding bikes are not going to be driving fossil fuel cars. They're going for EVs.
James, I just wanted to pick up on the point you made there about the Biden policy going, from Texas to the world, more global. I had a pretty interesting interview this week with Sharif Zuki, the chairman of I was going to say Cheniere, but of Tellurian, and he made the point that he was quite welcoming of the Biden team and their experience around energy. But the one thing he noted that has changed since they were in last is that the U.S. energy story is now a global one, and that the demand for U.S. energy, whether it be gas or oil in the world, we saw a data point, one of the News Digest stories, that China took about 400,000 barrels a day of American oil in 2020. So my point is that the U.S. is now a global energy supplier, and that when Joe Biden and his team go around the world to do their rehabilitation exercise, people will be asking them, can we have some of your gas? Can we have some of your oil? What's the answer?
I think in terms of gas, certainly, the US will continue to be a significant global gas supplier. But let's recognize that the gas story, if one's going to have a green flavor to the hydrocarbon story, it has always been in the space of gas. So that fits into, if you like, the Biden agenda. And certainly the LNG story is an enormous part of that and will be an enormous part of the hydrogen story as it goes forward. Look, the oil story, 380, 390,000 barrels a day imported by China from the US. Compare that to, the 1.7 million barrels a day that it imports from Saudi or it imports from Russia. It is a growth in terms of where it was a year prior to that, but it's noise in the scheme of things in terms of the importation into China. And if you come back to the point which Mike was making, indeed Andy was making, Saudi's just taken 1 million barrels a day off the market. So if there was a change in the cost metrics of US oil into China, it would easily be supplied out of OPEC plus. I think Mike in Singapore asked a question. Do I think, am I bearish on oil prices there? Much the same as the comment just made there. I'm certainly not bullish. I'm not bearish on gas. I think it is a very healthy thing for the industry to get used to the idea of oil prices at this kind of level, because this is the time when, if you're going to survive as a producing oil and gas company, you need to be able to be making your profits and your margins at that kind of a price point. If there are spikes because of some geopolitical issue, there will be spikes. But the reality is, if you cannot make money at this kind of price point in a low cost producing environment, it's time to get out of the business, Sean.
Well, the other thing Sharif was saying, that the reason the LNG price has spiked as it has is because of the lack of investment that has been going into a new supply infrastructure over the last few years, that consumers didn't take advantage of the low cost cycle to build new capacity, and now there's going to be a lot of volatility. Andy, welcome your thoughts on the outlook from the point of view of supply. We've obviously got shale coming back. OPEC might hold or not hold its discipline. I mean, we keep hearing that this is a demand story, but where do you see supply and its influence on the market as we kick off the new year? You're on mute. Sorry, Andy.
So supply, as ever, is a mixture of cost and revenue. So OPEC are looking at their revenues, shale oil is looking at their costs. And you've got this dichotomy that the OPEC are actually trying to manage price and manage supply, whereas actually some of the shale producers, for example, are just worried about, can I make money? So if there's an opportunity, they'll pull the lever. And it's this bizarre balance between managing the market and economics. So as the price stays where it is, we'll see more technology, more cost savings come into the oil industry. And then those producers that historically were higher cost become lower cost over time. So you've got OPEC actually implicitly supporting the high cost producers by keeping it in a range that is lower than it should be. And all of this comes into a very complicated picture where people want the price to go up. And if the price goes up, the people that are supplying the oil want to produce more. But you produce more and there becomes an oversupply and the price drops. That's why the oil market is so...
One of the things that OPEC have been quite focused on, and we obviously had the minister and the OPEC Secretary General on our forum last week, and both of them are pointing very firmly at inventory levels. And I know you have in the past sort of dismissed the week-to-week noise of inventory levels, and that's fair enough. But ultimately, the trend line, are we seeing that move sufficiently to where it's achieving OPEC Plus's goal of getting it down to a level where the 5-year average or something in which gives them a greater grip on the market?
So absolutely, because the more inventory you've got, the less impact that anything that OPEC does has. So if you've got 100 years capacity, OPEC can stop for 100 years and the price isn't going to go anywhere. So the higher the inventory, the less leverage OPEC have in terms of actually impacting price. We talk about 5 years. Why is it 5? Why is it not 6? Why is it not 4? It's just how much does the inventory impact OPEC's policies? That's all it is.
Yeah, and I suppose what it's useful for is that it's a data point. When you're trying to shepherd 23 countries, you got to have some target to aim at that everybody can agree on, right? It's sort of like, is there a fact that we all can agree on? We can't all have our own set of facts when it comes to a target. Let's go to the survey question before we go around to the panelists on their longer term outlook for the year ahead, looking for that horizon crystal ball, as we're asking all of our commentators this week to give us their views on. But in the immediate term, what will have a greater impact on the direction of oil markets in Q1? More trillion-dollar stimulus, soaring COVID infections, OPEC plus supply discipline. Inevitably, it's all of the above. We know that. But what do you think will have the greatest impact? Which one of these three things could have a greater weighting on the direction of the market? There seems to be a bit of a battle going on at the moment from day to day, week to week on these issues. And so I'd welcome the room's view on which they think is with the greatest momentum for the markets. Mike, coming back to you, and again, sort of taking a bigger picture view on 2021, what do you think we need to keep an eye out on? What are the bigger trends going to be?
The key thing that I find unique is every analyst, every strategist I speak to has assumed one key factor in every outlook, and that is the stock market will keep marching ahead. So I like to ask everybody, look, put your macro head ahead, put ourselves at the December next this year, and assume the S&P 500 is down 10%. What does that do for everything you look at? I view crude oil will be down 25%. Bond yields would be probably 50 basis points lower from here. Copper would be lower, you name it, all the above. The debt to GDP would be increasing, more QE, everything. The market, the stock market needs to go higher, yet it's at the highest level ever on a basis of market cap to GDP, not on a US basis, on a global basis. So to me, I see that, I'm like, that's a huge risk. I'd rather find ways to work against that. And that's why I always go to precious metals, things like Bitcoin. But anything I look at is all metals is where I can see a bull market in the future. And from an investor standpoint, you can hold on to metals. But crude oil, I just, it's stuck in a range, bear market. And I feel even like things like corn, it's up at very upper end of the range. And one thing that I've learned is a lot of this, I say it's US based, but it is US based, partly because remember, the US now gets 15% of their unleaded gas from corn. And that's really expensive. We'll have the highest, the US corn belt, the farmers, which is, I used to own a farm, will have the highest prices for sale for production in 7 years. And that machine of production has been phenomenal. Land grant universities, everything. So that supply I expect to come on. So I look for some volatility, expect dips and a bit of a shakeup and similar to last year, and stick with buying gold on dips and Bitcoin on dips and crude oil on rallies.
Mike, in terms of the sort of growing narrative, I think Goldman Sachs echoing it, I echo it a little bit, is the idea of the sort of commodity super cycle. Is that a narrative you subscribe to? What's your views on it?
It's too backward looking. It's missing. If you look at it's like watching volatility and looking to expect it to continue in the future. The old days of crude oil is over, and we've had good super cycles when the U.S. imported 10 million barrels a day. As of next year, or this end of this year, the U.S. will go back to exporting again. That was the paradigm shift from last year. Was the U.S. started exporting, and then of course we had the COVID issues. So I see that in metals. The only place I really see that in metals, and the key prerequisite for that is a weak dollar. And how do you measure the dollar versus other currencies? I think the best way to measure a dollar is gold. So I see a super cycle, a bull market in metals, most notably gold, industrial metals, Bitcoin, but not in energy and not so much in ag. So I have to narrow down the metals where I can at least feel comfortable. Demand is increasing, supply is declining. All this ESG focus, decarbonization focus, electrification focus, digitalization focus goes to metals. You don't want to hold and buy corn at 5, nor WTI and Brent near 60. So I see it. I know Jeff. I know Goldman Sachs. Jeff used to be a neighbor. You can't live near too far from me, so I know him well. But stick with metals. If you're looking for a super cycle, I'd say all the metals.
James, your thoughts for the bigger sort of horizon for the year ahead? Is it all things China? Does the whole thing anchor on the recovery of China still defying gravity and growing at 7-8%?
I think China's a factor in it, clearly. We're seeing a little bit of noise around COVID infections in China, but it's nothing significant. I think you put 3 categories out there as it happens. I thought they were all 3 interesting elements, but I chose the OPEC supply discipline because I think one of the things that isn't getting an awful lot of air yet and will feature in this first year of the Biden administration is what happens in the story around Iran, bounce on from that, what Venezuela, Libya, and what does that supply do into the markets? And I think that certainly Iran will be addressed by Biden in the nuclear agenda. It wasn't one of the first things he signs, but it's certainly a priority for him. So China is significant, but I think we are seeing global success, perhaps with the exception currently of the US, in terms of COVID vaccination. And I think that will make a difference. For me, I think the markets will stay up because there is an enormous amount of capital sitting on the fence. Just sitting, waiting to make a decision about where to invest. Mike's made some suggestions there in terms of his view of a commodity super cycle. Whether the money follows that path, I don't know. But I think there's an awful lot of money that is out there right now that is there to support a continued strong market in the markets.
Are we seeing, do you think, James, I'd welcome your views. There's been a lot of narrative in 2020 about China's recovery is limited because it has to wait for its trading partners in the West to recover also. I'm wondering if 2021 is a year in which China kind of breaks that sort of umbilical cord and stands alone more as an economic story. What are your own thoughts on that?
It has been the primary agenda of the administration there for some time to move away from an export-led economy to a more balanced economy with a significant internal marketplace there for sure. And clearly the internal middle classes of China are continuing to grow significantly, as by the way, as are the African middle classes, which is why I'm actually a believer that peak oil is still ahead of us rather than behind us, although I've been fairly clear about where I think the pricing is on that oil supply into the markets. I think China will continue to try to build a strong internal market because it provides a stability in the Chinese market. But I do genuinely believe that demand will start to come back across the Western world for Chinese products. And so I think China is potentially a winner on both counts.
Everybody needs their plastic China doll. Let's go to the survey answer before giving Andy the last word today. Okay. Soaring COVID infections gets 47%, greatest impact direction of oil markets in Q1. OPEC discipline and $1 trillion of stimulus sharing the spoils. Andy, your thoughts on the sort of 2021 horizon, bigger issues, trends to watch out for?
So I hope that the survey question is not right, because that was the one I did not want to ask. I think OPEC will be much more disciplined. I think that whilst I understand where Mike's coming from in terms of the fundamentals and what's there or thereabouts, I think the problem we've got today is that we have become, as somebody said, I think it was you, Sean, we've become addicted to stimulus. People just putting money into the markets. We've got lots of money sitting, waiting to go into the markets. They're just searching for something to put it into. And I think for me, it was seeing Elon Musk become the richest man in the world. Why? I can get my head around Bezos and Amazon. At least they're doing something, right? But Elon Musk, that doesn't make any sense to me. So to me, the issue is this stimulus, and it's the stimulus is keeping everything working and the market's kind of bumbling along and just kind of go up and up and up. And that's why I put that as being the biggest thing. I think if we change direction and suddenly it's taken out, then the foundation goes. And then actually, I think we'll see a very big downward spike across the board. So to me, stimulus and keeping going, that's going to be the biggest issue for 21.
Well, Mike gave you the answer earlier, I think, as to the wealth or the valuation of Elon Musk based on the outlook for China's demand for electric vehicles. It does seem to be rather massive. And again, I would recommend taking half an hour over the weekend to listen to Sharif's interview Chairman of Tellurian, because the other point ultimately he was making, which is a driver of a lot of things, it's sort of stating the obvious, but as it becomes anchored, is pollution. Pollution in major centers of Asia is a massive driver, will become much more pronounced in the year ahead, and all of these things become integrated. Thank you very much, Mike in New York, Andy and James. Really appreciate your insights and welcome you back to the table, and look forward to further commentary as we move forward. But have a great weekend, everybody. Those of you who are going into weekend here in the Middle East, further afield, enjoy the rest of the week. All the best. Thank you.
Thank you.
Thanks, Sean.
Thank you, Sean, Mike, Andy. Bye-bye.
Thank you, Mike.